Hello and welcome to Switzer Investing Insights, brought to you by nabtrade. And today we want to look at the outlook for investing over the month of July. Paul?
Let's start with June first of all and just see how the year's gone. Look, Peter, the market's up 17.2% year to date, 19.7% when you add dividends. That's the accumulation index. That's pretty good. Let's look at the components. That tells another story. The top 20 stocks, in fact, the top 50 stocks, Peter, are doing okay. In fact, they're leading the market. The mid-cap 50, which are stocks ranked 51st to 100, they're lagging a bit, and the small ordinaries, the stocks ranked 101 to 300, they're also lagging. So it's been the top part of the market that's really taken the market higher. Look, we get another story. We look at the actual 11 industry sectors that make up the market, and there are two standouts from this. First of all, communication services. That's Telstra, right? Yeah. Up 31.8%.
I don't think Vocus helped very much on this.
Last couple of years, Telstra's been a big weight on the market. Yeah. Telstra's actually done extraordinarily well and come good this year. But the other standout, I think, Peter, is that the gap between the best performing sector, that's communication sector services at 31.8%, and consumer staples at 11.4%. That may look a lot, but by historical standards, that's not a big gap. No. And so all the sectors are up, all are largely performing to some extent. And we've got a rather bizarre situation where it's not sector-led. There's some really unique factors at play. Big drop in interest rates helping cheap money, a lot of the defensive stocks. That's why things like real estate is doing well. It's why things like industrials are doing okay because of things like Transurban and Sydney Airport. The phenomenal increase in the iron ore price, which is all to do with the accident in Brazil in January. That's why the materials sector is doing so well. It stand out at 26.6. And gold prices have soared, again, largely because of lower interest rates.
Okay, we should
and a bit of uncertainty. So it's a funny market. It's not led by cyclicals.
And I think one interesting aspect is you mentioned real estate. A lot of people say, how could that just say, well, house prices falling? But this is more commercial, industrial, and all those sort of things, because it was like a bond proxy area when Bill Shorten was threatening no more franking credits, wasn't it?
And that's the way to money, because the yield you're getting on commercial property, people, that looked relatively attractive, and that's why they've bought real estate investment trusts. So that's why they're plus 19%. So it's been a tough market for a lot of the fund managers because they offer, and an unusual market, because normally when markets are going high, you expect your so-called growth and your cyclical companies to lead it.
Very unusual.
They haven't, right? In fact, a lot of them have been very badly beaten up. So stock pickers are doing it really tough in this market.
And low interest rates help those sort of bond proxy stocks. Let's go to the next big issue, namely the outlook for July, the international issues.
Well, undoubtedly the trade dispute, Peter, is the number one issue globally. And look, I guess your guess is as good as mine. I mean, I think Donald wants to sort of play this right out. Yeah. He wants to win. But again, he's got the pressure of the election in the US next year. So he'll need to do a deal, but it doesn't seem, despite the rhetoric at the G20, doesn't seem any super hurry to get that done.
Well, he's been helped by Jerome Powell, the Fed boss, who now is talking about interest rate cuts. That gives him time to drag out the trade talks. Otherwise, he could have a recession on his hands. And I think that's the reason why we probably will have to wait to see what happens.
Well, that leads me on to the US Federal Reserve, Peter. That concludes its meeting on the 31st of July. Market expectation is for an interest rate cut there. We'll see. Iran's a bit of a curveball still, so still out there. There's some noises in Iran, and that's going to play out.
And helping the gold price as well.
Helping the gold price. Look, the big news for the US this month is, of course, it's the start of the quarterly earnings season. So this is Q2, quarter two in the US. And it really starts at about the 12th of July, peaks about the 30th of July, Peter, so it's right at the back of the month, but you're going to see the market very much focused on how earnings season is progressing. Current forecast is not much growth. In fact, some analysts saying it's negative of about -2% to some who are just marginally positive. This, of course, is comparing this quarter two of 2019 versus the same quarter in 2018. That says a lot of things about the market. The market's gone up a lot, but earnings haven't. And again, maybe it won't be so much the historic number that the analysts are worried about. It's more about their forecast for quarter three. So that's a big issue to play out.
Because that forecast will be affected by whether the individual companies are being affected by the trade war. It's going to be a very important revelation for the stock market.
And we are hearing increasingly news of more companies being impacted by the trade war. Tariffs, remember, are a tax. And they increase the cost of lots of companies. So if you go to the Midwest, then arguably quite a few companies saying that tariffs are starting to hurt them. So look, we'll see how that plays out. And of course, it's summer holidays in both the USA and Northern Europe, and typically markets get a little quieter in that period. So there's some of the things on the horizon in July internationally.
Okay, let's go to the local situation now.
Well, we're seeing 2 rate cuts, so the big question is the Reserve Bank on hold?
I think so, until Cup Day.
Right, so I think that's important. Look, we've also got a tax cut to come through, so that should help give a bit of stimulation. But for us in Australia, the big issue is earnings season in August. We only have 2 of these, and of course this is most companies' full year earnings report. So what we will see in July is more of confession season. That's when sort of companies with any bad news try to get the bad news out of the way before they hit with their earnings.
It's so religious, isn't it?
It's a bit religious. But we do have these very cashed up investors, and that's what the big impact of 2019 has been. We've got so much cash out there. We had all these dividend payments, we had all these buybacks. Interest rates come down so low, lots of people in term deposits saying, what do I do with my cash? And no new supply. We're not seeing any IPOs or things to wait to soak up the cash. That's one of the reasons why the market has gone up, because just the function of demand for stock. I still think investors, you look at the figures coming from a lot of the fund managers, still pretty cashed up.
And if interest rates are so low as they are, people have to chase income somewhere, and that's why defensive stocks have done very well. But you look at it this way, Paul, a market does invest ahead of what might happen in 6 months' time. This market is actually predicting that the economy will improve, tax cuts, rate cuts, infrastructure spending, a lower dollar, a new government, all these things I think conspire to give us a rough chance of seeing the economy improve in the second half.
Well, on that basis, you'd be looking at some of the cyclicals, Peter, but it's a pretty brave call. I'm a bit wary about defensive stocks because they've had a great run, and I just wonder how much further they can go. I mean, it's an unusual market.
Well, what would you be investing in?
Well, I'm a little wary, so I still think this is a market to be long and still, right?
Yeah.
Because the trend is up, and there's no reason yet to change your position on that market. You've got to play markets for the long term. So I think if this is probably more the case, a little slightly more defensive way to play this market is look at some of the index stocks.
Yeah.
That way you're fairly nimble, you're not exposed to some of the individual stocks. So
what you're saying, Paul, is you're buying an index for the top 200 stocks in the ASX 200 index, like the A200 ETF from Vita Shares, STW, Vanguard's VAS, and iShares IOZ.
Yeah, and if you're a little more courageous, Peter, you might like to look at some of the cyclicals. Yeah. One way you can look at that potentially is through things like the small ordinaries, and there's of course an iShares ISO is.
That's for the courageous.
It's for the courageous. But look, I think I'm a little nervous, and I think I'm going to play it. Yeah, more through an index basis, I think.
But eventually, Paul, as long as there is a trade war settlement, there will be an uptick in growth, and that will be good for the rotation aspect out of those defensives into more growth-oriented
And we
stocks.
see that all the time. Rotation happens, and eventually the market will like cyclicals again. But again, you've got to sort of pick the timing on that a little bit.
Without a doubt. So that's Switzer Investing Insights, brought to you by nabtrade. Thanks for joining us.